Returns. As a human being, we always think in terms of return, whether it's your salary, whether it's your promotion, or which movie I want to watch. So you will always think whether it's worth my time, whether I should invest my time to watch that particular movie. Even if you are going out with your friends, there is always in the back of your mind, what is the fun I'm going to get? What is the happiness that I'm going to get? So we human beings think in terms of return on investment, whether it is your time, whether it is your money. That calculation is always going in the backdrop. And let me tell you, if you understand investing like this, return on capital employed, which is return on invested money, for a company is one of the most important metric. That is what you should see as an investor. And in this session of our YouTube channel, we are going to decode this entire principle, and we are going to go really deep in this one concept which will blow away your mind. So if all of you are ready for this powerful session, just type ready in the comment box. And by the way, I have taken this session inside our community, and I thought it is a very powerful concept which I should share with all the outside people. This is a special masterclass which I'll be going deep dive, and please make sure you take lot of notes during the session. So let's dive into the world of return on investment, return on capital employed, and how it makes sense for you as an investor. Let's go into this. Awesome. So let's deep dive. I'll share the entire journey of why you should be thinking as an investor about ROCE and how it connects the dot in the subsequent part of this masterclass, which I did with my community. Let's go in. So there are basically two parts when it comes to thinking about a business. Okay. So let me just share the screen. And so there is this Rocking Ranjita's Vada Pav stall, as we know, at Gokuldham Society in Mumbai. She is having a Vada Pav stall. Okay. And she is selling Vada Pav. She has put 1 lakh rupees. And in a year, she is able to make, say, 8,000 rupees out of it as a profit. Okay. Now we know that any company, if it needs to expand, what it needs to do is earnings growth, right? So if they want to grow, what will they need to grow? They need to grow this profit. So they can grow this profit in two ways. One is, they make business so efficient and do all sort of those things, and they can bump up a bit. Second is what we know through 4-cylinder model. Okay. They can launch new products. They can go into new geography. So that is what they can do. Like they can, go to new geography. They can increase their sales. They can launch new high margin products. They can reduce their debt and so on and so forth. But having said that, this is just one part of it, right? What if I tell you that Rocking Ranjita, if she is in Mumbai, and 1 lakh she is making, say, 8,000 rupees, and assume right now there are no taxes and everything. Let's keep it simple. So 8% return on investment she is getting. Now, if she is getting option to open a new stall in, say, Pune, and if the dynamics of the business are going to remain same, that if she is investing 1 lakh rupees more, she can earn again 8% or 8,000 rupees out of it. Now, the question I keep asking all the time is, what should Rocking Ranjita do? Should she go ahead and book this or not? Should she go ahead and go to Pune and open up the store or not? So at this point of time, rationally, the answer is yes or no. We don't know. That depends upon what? That depends upon what is the risk-free return. Okay, so right now, if I just give you this data point, you can say yes or no both. Now, somebody who has already attended, that ultimately the answer is no. But at this point, the answer is either yes or no. If it is similar business in US, maybe it might be a great business to get a 8% ROI, because the risk-free rate there might be like 1 or 2%. Now, even US, it has started to shoot up. But imagine, your bank FD returns are just 1%, and if you are able to get 8%, it's a crazy, kind of delta which you are getting. Okay. But if you talk about India, and if say India, your government bond rates are say 7.5% or 8% is your FD rates, if you combine that with that question, does this make sense to open up a new store and grow and taking so much of business risk, right? Because it's not that every time you will get 8%, or even if you get 8%, it comes with so much of risk. There is risk of, business slowdown. There is risk, say something like COVID happens, or sometimes, your employee asks for more salary. Sometimes regulatory issues are there. So there is so much of, pain when it comes to running a business, right? There is a lot of risk which is on the way. So if you are doing a risk-free 8% and you are doing so much of risk and taking 8%, it's better to go to Goa, chill, put money into FD and earn that 8% through FD. Is it making sense? All of you getting it? So the point I'm trying to make is growth without profitability, okay, is not a good idea. Now, again, sometimes it could be a good idea. Okay, I'm just twisting it. This I have not shared any time. Can you tell which places it will be a good idea to have suboptimal returns than your FD returns? In which situations can you think about it? Just type in the comment box. Let me see how much out of the box you are thinking. Same area, again, there is no logic whether it is same area or other. Economics still remains the same. Yeah, so one very good one is recession, right? So say for example, in the worst scenario, in a recession, what I would mean is in the worst cycle of that business. So in that vada pav business, although it is not very cyclical, but say a steel plant or a cement plant, in a least cycle, it is giving like almost nearer to FD rate. But when the cycle picks up, you make like crazy returns. Then it makes sense to open a business during that bad phase of that cycle in that business. Yes, good point. What else? Uh, Taxation could be possible to run the show for future, right? So in what sense? Again, you are right that in future, if we can make better, it might make sense right now to bear that pain. And in future, I might make much higher returns, say 15-20% returns also. If you are building a platform business where upfront you need to put a lot of money, right? So if you want to build a platform like CDSL, if you want to build a platform like Zomato, you have to put a lot of cost upfront and leave profitability. Sometimes you will burn money also. Like Amazon, it was making losses for so many years, but it was building a platform and it was like kind of getting that scale, which ultimately can lead them to a crazy kind of profitability, right? If you can, for 2-3 years remain at 8% ROI, but your Ramu Kaka and a lot of other competition goes away because of that, and then you have like an open ground to make a lot more money, then it makes sense to penalize yourself for a short period of time. Excellent, right? Yeah, if it is initial phase. So if you feel that right now the overall occupancy itself, like overall utilization itself is 30%, but I can easily do 100% utilization from where I am, it perfectly makes sense. Yes, if I'm getting subsidy in the business, again, not a very good reason, but yeah, understood, noted. Or you probably feel that the FD rates are at a peak and that might fall. Your cost of capital itself will go down. Then it again makes sense. Yes. Again, to build a brand, right? So I am right now, a small player in Mumbai, but I just want to create a visibility across, say, entire country. And even if I don't make money, if I'm making cost to cost, in future probably that brand will enhance my profitability. If that is the vision, it could make. Now let's think about the rational way, right? So I don't want to settle for this 8%, because if I do business at 8% without all these things which we talked about, it's a plain vanilla business and forever it is going to give me like 8-10%. It is not going to make sense to operate at 8%. So the question is, what is this 8% and what we are talking about? It's concept called ROCE. It's called return on capital employed. Itna dala to kitna taka milega. That is what even we do in the market, right? Everywhere we think about ROI. Come on. Any decision we make, we think about ROI, whether it is, tangible or intangible. If you go out for a movie, what do you think about? You feel कि यार इसमें कितना मजा आएगा, ये मूवी देखो कि ये मूवी देखो, right? So there also you are comparing whether to do FD or whether to start a business, right? If you are going and ordering a food in restaurant, you are again doing the same thing. ये फूड ज्यादा टेस्टी होगा या ये फूड ज्यादा टेस्टी होगा, ये 100 रुपए में ये इडली के लिए दूंगा उसमें मजा आएगा कि डोसा में 100 रुपए दूंगा तो उसमें मजा आएगा. That is again ROI you are thinking in the back end, right? When you are going and driving, you see कि अरे ये रूट में जल्दी पहुंचेंगे कि ये रूट में जल्दी पहुंचेंगे. तो अगेन यू आर थिंकिंग इन टर्म्स ऑफ रिटर्न ऑन कैपिटल एम्प्लॉयड. अच्छा यहां कम गड्ढे होंगे या यहां ज्यादा पोर्टल्स होंगे, राइट? आई विल टेक अ रूट वेयर देयर आर लेसर पोर्टल्स. अगेन यू आर ऑप्टिमाइजिंग योर डिसीजन बेस्ड ऑन the effort you are putting to drive that car and your car's depreciation and the time invested versus the reaching goal, which is your return. Okay, so that is everywhere. Like even when you go to a khao gali and when you see vada pav khaye ki pani puri khaye ka ye bhel khaye, that is also like that decision. Okay, so everywhere in our life, either financially or non-financially, we are always, our brain is thinking in terms of ROI. So that is the driving factor which is central to the business. Now, good thing about the business is every decision you take ultimately boils down to ROCE. Let's understand that. Okay, so let's understand this very powerful concept through this slide. Okay, so in business, this is the slide called return on capital employed. This is the slide which is called return on capital employed. Now, if you see, there are two parts when it comes to return on capital employed. Okay, the first part, numerator, is EBIT. Now, how does EBIT gets calculated? This is how it gets calculated. Okay, so it starts from revenue, whatever revenue you make as a company, then whatever cost of your goods sold, right? So if you are making say vada pav, your cost of your oil, cost of your vada, cost of your butter, cost of your masala, cost of your bun, everything is cost of goods sold. So whatever is used as an ingredient to prepare that good is called cost of goods sold, and you are left with gross profit. Then you have all the kind of expenses when you are running a business. So you need to give salary to your staff, you need to pay rent, you need to pay maintenance, you need to pay for electricity bill. All these are operating expenses, right? And then if you have put up a machine, say if you have put a big fridge, if you have put a big tawa, that is like a upfront capex which you have done. So you are depreciating that asset every year. So if you have put 1 lakh rupees asset for 10 years, you are going to use it. Every year you have to depreciate that asset, because after 10 years you need to buy a new one and it will cost you upfront, right? So you are basically adjusting for that, which is called depreciation. And then you are coming to a number which is called EBIT, which is earnings before interest and tax, which is pure operational metrics, which means if taxation increases, it doesn't get affected. If your interest increases or decreases, it doesn't affect. It's purely from the business operations, whatever cost you are incurring, that is what it takes care of. That is where it is giving you a pure sense of business, and it is comparable apple to apple basis or orange to orange basis versus other business. So if you want to compare a cement business with a other business, you should compare with EBIT, because that is like a purest comparable metric along with other business. Okay, then on the denominator you have capital employed, which is like ये सब करने के लिए कितना पैसा डाला है, right? So what is the equity you put in as a shareholder, and what is the debt you have raised from Rancho uncle to run that business. So any kind of equity or debt capital which you have raised is called capital employed. So tell me, if you want to maximize your ROCE, that is return on capital employed, what you need to maximize. What you need to maximize. It is not PBT, because PBT is after interest. Okay, and it is not same. Okay, PBT and EBIT are different. That is why it is EBIT, and that is why that one is PBT. Okay. Okay, so to increase ROCE, you need to increase the EBIT. Yeah, increase the numerator. As much high it will go, the more will be ROCE. All of you will be with me. Simple. We are not even going to revenue and everything. Okay. So are you all with me that if you want to increase ROCE, numerator should increase and denominator should go down? All of you with me? So numerator should increase and denominator should go down. Now let's think about it. If we want to increase the numerator, क्या करना पड़ेगा? We should grow our revenue. And we should reduce our raw material cost, we should reduce our expenses, we should reduce our depreciation. So पैसा ज्यादा लाओ, खर्चा कम करो, सिंपल है. इन्वेस्टिंग इज सो इजी, लाइक हाउ वी रन अवर हाउस, सेम थिंग इट हैपेंस, राइट? सैलरी आया तो उसमें से कितना खर्चा हो रहा है, दैट विल मैक्सिमाइज द इबिट. गवर्नमेंट तो जो टीडीएस काटना है वो तो कटेगा ही, राइट? सो द पॉइंट इज हाउ वी मैक्सिमाइज रेवेन्यू एंड हाउ वी डिक्रीज ऑल these things. Now if you go deeper and start thinking about this topic, each and every decision management takes revolves around this. So if management say, hey, not just Pune, we will go to, outside Maharashtra, we will go to South India, we will go to this state, we will go to West Bengal. If they start thinking about expanding the company, a strategic decision to grow a revenue, that affects your EBIT. If they think, hey, I'll launch a new category, not just vada pav, I also want to sell bhel, that is a strategic decision which management is taking. If they say, hey, we will bargain with our suppliers, let's switch the supplier from this one to this one, and they gain some additional revenue out of it or additional EBIT out of it, that's a management decision, right? If you say, hey, instead of hiring people, I'll outsource that, I'll have human resources firm to take care of the employees, and that will bring more efficiency, it will cut down the cost, that is a management decision. If they say, hey, instead of buying this expensive asset, we'll buy a slightly cheaper asset, or let's buy a more expensive asset which might be even more efficient, that is a management decision, right? Hey, instead of raising a debt, let's put more equity and let's limit the use of capital, let's try to optimize the cost of capex itself, that is a management decision. So if you think about it, everything what is happening inside the company ultimately boils down to only these two numbers, and then ultimately only this number. And that is the reason, if you want to think about how the business is operating, and if you want to compare even in the same sector different businesses, you should always compare. What should you compare? ROCEs. That will give you so much insight that, hey, management is renting or buying the office building, whether it is renting the machine or outsourcing it, whether they are getting the job work done or manufacturing themselves. All these decisions will come into ROCE, whether they are, yes, expanding their own company or they are doing a franchising. That is a capital light model, right, where you are not raising more debt or more equity to expand, but you are just writing a check and signing an agreement and franchising it. That is again a management decision which will affect the ROCE. So are you able to understand why this metric, single most metric, is so important in our investing journey? And in the Indian parlance, our aim is to minimum find a business which is doing around 15% ROCE. The number is what? The magic number is 15%. So 15%, if they are able to do over a slightly long period of time, that suggests that they are really doing something good. Okay, so the number to look for a threshold is minimum 15%. Again, as I said, some businesses could be like initially bleeding and then they cross 15%. That's perfectly fine. But a steady state business, a growing business with a 15% ROCE is a great combination. But still, there is only one thing you need to think about when you enter these kind of business. What is that one thing? Longevity or longevity. Okay. So the business, whether the existence is there or not, and what does kill the existence? Or old business model or outdated model. So if I'm selling DVDs right now, I might be making money, but then if I don't have the longevity of that business, it is fine, gone. I might be able to sell newspapers today, but will that newspaper 10 years down the line people will read? Mostly not. I see when I used to go to London, people distribute newspaper for free because nobody is willing to read it. Okay. So the longevity is the third thing, which you need to think after both these things are taken care of. Now, there is a metric which you need to focus on, which is this. Okay. So this is the metric which we focus on. So when it comes to thinking about the business models, essentially we categorize broadly into this quadrant. Okay, so one side is return on capital employed. Okay, so this side is return on capital employed. This is like your y-axis, and this is your x-axis, which is more like a earnings growth. Okay, so essentially, when you think about a business, you need to think about what is the kind of growth of this business and what is the kind of return on capital employed, which this business generates. And that is where we go about this entire, mathematics of investing, which I kindly learned from one of my mentor, Professor Sanjay Bakshi. And this Excel I've tried to model from what he shared, and I have rebuilt it. So all credit goes to him. And this is what we pretty much built. Okay. So prevailing interest rate, which is like your FD rate, say it is 10%. Okay. And I'm right now just removing this management fees to keep it simple. Now say a business A puts up a plant. Okay. So 100 rupees they are investing, say 100 crores they are investing into a hotel. And at the end of the year, the hotel earns 6% as a return. We are not even talking about a loss-making business, by the way, here, right? So loss-making businesses are totally different kind of business model. Unless they ultimately turn profitable and get good ROCE, we don't need to even think about it. Okay. So in a year, they are basically doing 6% return on capital employed. And right now, let's forget it's a zero tax, okay, debt free. So no interest. So your EBIT is equal to PAT. Let's right now simplify it. Okay. So are you all with me so far? So what we are doing is we are making earnings of 6 crores at the end of the year. Okay. So what happens is your end net worth of that company. How does the net worth gets calculated? Your equity and your profit goes to reserves. So your net worth is 106 rupees. Okay. Now your overall net worth is 106. Now either you pay out that as a dividend, so then it will not come into your equity. But if you are reinvesting into the business, it comes into the liability side because this is what belongs to shareholders. So total equity will add up. So your reserves will get added to the original shareholders' equity. So now your liabilities is 106. So that 6 rupees might be going somewhere. So either it can be sitting on a cash or it goes in an inventory, or you reinvest that to make more machinery and make more business out of it. So assume that we are using that money to reinvest inside the business. So say for example, we had a 100 rooms hotel. Now we add 6 more rooms. All of you with me? So we are adding 6 more rooms. So what happens now, because the return on capital employed is still 6%, you are now earning some 6.36 crore out of it, and your end result is this. And you keep doing this compounding every single year. And at the end of 10 years, your net worth increases to 179 rupees or 179 crore. So what is the return all the shareholders got by investing into this business? So imagine you are a shareholder, you have put in 100 rupees of money into it, and say after 10 years, we close down the business, return all the money back to the shareholders. So how much return shareholders made at the end of 10 years? So 179 minus 100 rupees, right? So 100 rupees you had put in. Imagine you did a FD of 100 rupees and at the end of 10 years, you got 179 rupees. So you got absolute returns of 79% for 10 years. Are you all with me? Is it making sense? Making sense? Understood? Simple enough? No complications, right? So let me just recap. So we are starting with 100 rupees, 100 crore ka hotel liya, and then we kept on increasing rooms as we kept on getting more money, and the returns remain same. So we kept on earning 6% from whatever reinvestment we made. And at the end of 10 years, we are selling out that hotel, and whatever money is there, we are distributing back to shareholders. As simple as that. Okay. So in this business, even though, we were reinvesting, we got 79% return. That is 179 minus 100. Now, let's understand business type B. So business type B, what we are doing is same return on capital employed. Okay, so 100 rupees we are putting as a net worth, beginning net worth, and we get 6% ROCE. So next, year we are getting 6 rupees out of it. But promoter knows by prevailing interest rate is what? 10%. अरे यार ये बिजनेस में 6% मिल रहा है, तो व्हाई नॉट टू पुट माय मनी इनटू एफडी. सो अभी होटल बनने के लिए बन गया. व्हेन वी डिड अवर एस्टिमेशन वी थॉट इट विल गिव मी 10%, 12%, 15%, बट इट we realized that it's a pathetic decision we took. Now we built the hotel, what to do? So let's now not make that mistake again, and whatever money we are earning, let's give out as a dividend. Okay, and assume that dividend is tax free here. Okay, so we are just in a hypothetical world, we are just trying to think so that we understand the math. And the dividend, when the shareholders receives or the promoter receives it, they think like अभी इसको तो बैंक में पड़ा नहीं रहने देना है, इसको एफडी कर देते हैं ना, 10% रिटर्न आ रहा है. So that person is doing FD of that for next 10 years. And that 6 rupees compounds and makes almost 14 rupees. So what we are doing is we are compounding it for next 10 years, and it becomes like a 14 rupees at the end of 10 years. All of you with me? So that FD, reinvesting, and after end of 10 years, it becomes 14 rupees. Next year, same thing happens. So we are not adding more rooms to the hotel. Same 100 rooms hotel, giving us same 6 crore rupees, revenue. And we are again, giving out everything as a dividend. And that again compounds for remaining 9 years. This compounds for our remaining 8 years, this 7 years, and so on and so forth. So all this money keeps accumulating, and last year, you don't compound. So at the end of whatever 10 year, you get 6 rupees, just get added. So what you have done is essentially all this dividend which you got for 10 years, by compounding that, you got 95 rupees. So your 100 rupees adding this dividend has become 195 rupees. All of you with me? So what is the difference we did in both of these things is, one business we reinvested, other business we are taking out money from that company, because we feel that outside the company it is compounding better at a 10% rate. So tell me, business A is better or business B is better? Which one is better? Business B, of course, because I'm getting more money at the end of the day, right? After 10 years, when I liquidate, I'm getting 179. And after 10 years, when I liquidate this company, I'm getting 195. Okay? Because you feel, higher amount is not good, the lower amount is better, then I'm with you. Okay? So this is what is better, right? You get more returns for the money invested. Okay? So this is what business B is better. Yes? Simple. All of you with me? Simple math, nothing rocket science we are doing. I am just asking, 179 rupees is better as a return or 195 rupees is better? That is only question I am asking. Okay. So 195 is better. Yes, getting me with you? So now let's think about another way, right? Third type of business. Third type of business is business C. Now this business is high ROCE business. Okay. So high ROCE business is where you are earning more than your cost of capital. So your cost of capital is what? 10% or risk-free rate right now. You are earning much more than that. So you are earning 20% on whatever you have invested. So 100 रुपए का 100 करोड़ का 100 रूम बनाया, 20 करोड़ का profit आ गया, right? And then you say, if I increase the room, will that also get filled? You say, yes, if I add 20 more rooms, I'll reinvest 20 crore back to expand my hotel. It's again giving me 20%, so 24 crores बन गया. ये तो बहुत सही है. Now 144 हो गया अपना end net worth. Now that again, whatever 24 crores, if I put back to the business and I increase my room count to 144, can I get the same 20% ROC? Yes, because there is so much of demand. There is no hotel on that city. And what hotel we are building is best in class. And we are having very scenic view in front of river, in front of waterfall. So nobody can compete with us. So हमें premium देंगे लोग, right? So then you again get 28 crore next year. So say और room बनाते हैं. Again, you made more rooms. So now you have 173 rooms. And that is also giving you 20% ROC. There is no competition. You are able to charge whatever you want to charge from your customers. So again, you are getting 34 crore out of it. And again, you put it, again, it is getting sold out. Again, 20% profit you are making, and that cycle continues. So at the end of the 10th year, you have 1619 as an end result. How many of you feel this is like crazy? Just type crazy in the comment box. So the same business, just by changing the return on capital employed, see, growth was same. Okay. They were reinvesting the full capital even in type A kind of business. But just because the cash available at the end of the year was very small, you could not reinvest so much. And even if you are reinvesting, your returns are pathetic. But here, that compounding is happening at much higher rate. Okay. And if you're feeling this crazy, something more crazier is going to happen after some time. Okay. Just hold on your breath. After some time, even something crazier is happening. So this is type C. Now, similar to how we compared A and B, let's think about a business where 100 hotel room, you have put a strategic place, which is in front of river, there is a waterfall, so your hotel is like crazy location, but it is having small space, so you cannot expand it. You have a constraint. Okay. Or it is a very small place, on only 100 premium tourists come at any point of time. So if you expand more number of room, there are not more tourists coming in, more customers are not coming. So 20 rooms will remain empty. So it's not a wise decision to expand your hotel from 100 rooms to 120 rooms, because there is no reinvestment opportunity. Your returns will fall if you try to expand, because you will not be able to utilize that much of inventory. Are you getting me? It's like, uh, the demand is limited, or if I expanded, the competition might, affect me. Okay, so it is like an optimum space where I'm operating right now. So what this guy is doing, it knows that it's crazy, milk, cow, it is cash cow it has got, and it can milk this business very nicely, but it cannot expand. तो हम क्या करने का, 20 रुपए कैश में तो रख नहीं सकते, बिजनेस में पड़े पड़े तो कुछ रिटर्न आने नहीं वाला है. सो लेट्स गिव दिस आउट एज अ डिविडेंड. सो 20 रुपीज डिविडेंड. शेयर होल्डर्स आर स्मार्ट, दे पुट मनी इनटू एफडी. 10% तो आ ही रहा है, तो 10% तो लेते हैं, राइट? सो दे आर पुटिंग मनी एज अ 10% इनटू FD, and that dividend money is compounding here, just like business type B. And every year the room inventory remains 100, and they keep getting 20 rupees every single year. So at the end of 10 years, what happens? Your 100 rupees to as it is rehta hai, and your dividends have compounded to 318. So your total returns are, from 100 rupees you have earned 318, and from 100 rupees here you have earned 519 if you remove out your own capital. Okay. So which business is better now, C or D? Very obvious, right? इसमें ज्यादा रिटर्न मिल रहा है, 619 हो रहा है अपना 100 रुपए, इसमें 418 हो रहा है. So definitely this business is better. So now tell me this, is it always good that business should give dividend to the shareholder? Yes or no? Like if this company starts giving dividend, जूते पड़ेंगे इनको, मैनेजमेंट को, कि यार if you can expand and sell at a 20% ROCE, why are you giving me a dividend? You grow, you make money for me long term, you build capital gains for me. Why are you giving me money? I don't need money. I want to grow your money. I want to grow at 20%. If you give me money, I'll grow only at 10%. Right? So as a shareholders, we are better off putting that money back to the business and reinvest that capital. So it is not always good that a business gives out dividend. A lot of people run behind dividend. अरे ये company dividend देती है क्या? Before that, you should ask whether this company is reinvesting at higher ROCE or not. Dividend nahi deta, it's okay. It's growing its capital. Right? So that is the case. Now, in case of low ROCE business, first place, you should not be investing in a low ROCE business, right? But just worst case, suppose you are invested, are you better off if you get a dividend, or better off if you don't get a dividend? So in this case, daag अच्छे है, right? Dividend देते हैं, that is good, because at least they are not burning our money into a suboptimal returns. We can at least put money into FD. कि भगवान इसको सद्बुद्धि दे, नहीं कर सकते हो expand ठीक से, then at least give it back to me. I'll handle it. All of you with me? Yes. So this is where, you're reinvesting into a low ROCE business. Unless you don't see a future ROCE increases or future strategic decision, it's a pathetic decision. Okay. So this is where, dividend is good. Now there is a type E business, which is not listed here, but there is a type E business also. What is the type E business? Which is best of both worlds. What is the type E business? Which can grow without reinvesting. That is called platform business, where something like Facebook or Google, right? They don't need to put incremental money to grow. Ek app bana diya, more and more people come in. There is no incremental cost. CDSL, IEX, right? So that is the ultimate business where they can give dividend to you and still it will grow your capital. Best of both worlds. Brokers, yes, all the tech platforms generally have these characteristics, but most of them have very high upfront cost. And what they do, because they know that they can grow faster, they use that money to acquire the customer. So it is called customer acquisition cost. So they burn some money upfront to cope up with that. Okay. So now essentially there are four types of businesses. The first one is called cactus. Now what is cactus business? Low ROCE, low growth. Okay. This is like your type B business, which is giving out dividend. Usko pata hai I cannot grow and I should not absorb water. So it's like a cactus, which doesn't like to grow and it doesn't take any water. It grows in a dry region and grows very minimally. Okay, small leaves, whatever it needs, it just barely kind of survives. So it gives like all the dividend. Now, Nutcut Kannaiya, this is the one. Okay, this is the Nutcut one. This Nutcut promoter, because that promoter might be getting good salary or it takes percentage of profit and it can, harm the minority shareholders. This Nutcut promoter is willing to grow even by not giving dividend to the shareholders. Okay, so that is called weed. The more water it takes, the more resources it takes, it actually, is not good for the entire field. The third kind of business, which is business D, the last category which we discussed, which knows that it cannot expand, it can only have 100 rooms. If they try to reinvest, the ROCEs will fall because they will not be able to utilize that capacity. There is no incremental demand. That is your mango kind of business. Har saal aam milta jayega, but it will not become big tree beyond a point. It will be saturated. Tree ka size itna hi rahega. Every year you can eat rasila aam from it. That is your category D kind of business. Okay. And the ultimate category is your core compounding companies. Just like banyan tree, it will reinvest and become so big one day, you will not even realize which is the main trunk. That is like how that compounding will happen. This is which type of business? Okay. Which will keep reinvesting at a higher ROCE. Now, the interesting thing is that business doesn't remain in that one zone most of the times. Okay. Like generally the statistics is the top one remains like that. Okay. So mostly the top category, there is 89% of chance that something which is banyan or mango will remain like a banyan, or worst case, banyan will become like a mango, which means growth will go away in future. Kitna expand karoge, right? So that is what is the statistics. And same way, it is said that almost 80% of the time, kachra will remain kachra. Okay. So if you buy kachra also and if you hope that kabhi na kabhi Suzlon Asian Paints ban jayega, nahi banega. 80% of the times nahi banega. Right? It will remain Suzlon kind of cyclical business only. If you think ki Astral kachra ban jayega, 80% of the chances are there it will not become kachra at least. Worst case, the growth will go away. Okay? Getting me? If you think like, Tata Steel will become like Titan, it will not become. Tata Steel hi rahega. Right? Titan is a whole new, different banyan kind of pedigree. It cannot be like, and Titan will not become like a Tata Steel so easily. Okay. So, yeah, a lot of people expect that Yes Bank will become HDFC Bank, but there is only 20% chances. But yes, sometimes it can become, right? And sometimes even HDFC Bank can also become Yes Bank. That is also another thing that happens. That is 20% of the chance. So the point is, when you select your core portfolio companies, it is better to select in this category, where you have at least a good high ROCE to start with, and ideally a growth also to start with. But mostly if it is a well-discovered and if the growth is there, the entry multiple, the valuation which you might be paying would be slightly high. Okay, because everybody knows ki ye Titan hai and Tata Steel nahi hai. Right? So it's not like only just you know it, everybody knows it. And that is where they will demand premium for it. But the best part is this, which I was telling you that it will get crazier. The best part is this. So if you hold these businesses for a longer duration, okay, that is where the magic starts. So if you hold these businesses for 20, 30 years, and if it really keeps compounding with the longevity of that business, your 100 rupees will become 23,000 rupees. Okay. How much it will become? Almost 23,000 rupees. Hope the Excel and linking and everything is correct. But that is how the crazy compounding will happen. But if you buy this kind of business, even at a 5 multiple, let's see at 30 years what it happens. Even if you buy it at a very cheaper rate, it will only become 500 rupees. Hopefully my Excel is working properly. I'm hoping. Yeah, it's compounding at 6%, right? Yeah, I think it is doing. Yeah. So are you getting it? How astronomical difference it is between this business and this business. Now imagine इसको आप कचरे के भाव में ले रहे हो, right? So instead of paying 100 rupees for that 100 rupees book value, you are buying it at 20 rupees, which means 0.2 times book value. बहुत सस्ते में ले रहा है आपने. So 20 rupees will only become, after 30 years it will become what, 500 rupees. And तब भी वो कचरा ही है, तो आपको कोई 500 देगा नहीं ideally. उसके लिए they will give you only 250 rupees. So you will make probably 10 times money in 30 years. But here, if you have paid 5 times the book value, बहुत expensive PE पे ले लिया, 500 रुपए पे ले लिया, and if you hold it for 30 years, divide 23,000 by 500, what is the multiple you are getting? Till you will multiply your money by 46 times instead of 10 times in that kachra business, even though you are paying 5 times book value to start with, even though you are entering at an expensive looking price. But the answer is if it keeps compounding. Okay, if it keeps compounding and if you hold it long enough, it will make crazy money for you. And that is what our late Charlie Baba, Charlie Munger the Great, told us. That over the long term, it's had for a stock to earn a much better return than the business which underlying it earns. If the business earns 6% on capital over 40 years and you hold it for 40 years, you are not going to make much different returns than that 6% return. But conversely, if a business earns 18% on capital over 20, 30 years, 18% on capital is basically ROCE, what he's telling. And if you are reinvesting that, even if you pay an expensive looking price, you will end up with a hell lot of result. Okay. So that is where if you want to play core, you need to make sure that it compounds. That is the most important necessary condition than anything else. Valuation comes secondary, but will this business keep compounding? Will it grow? Does it have really good competitive advantage? Will it keep reinvesting its capital? That is a bigger question to ask. I'm not saying valuations are not important, but those questions are even more important. And even if you are getting all these kind of businesses at a cheaper valuation, or even this mango kind of businesses at a slightly cheaper valuation, if Titan is at 40 and your non-growing business is at 20, if your holding period is say 5-7 years, you are still better off by holding a 40 PE stock which will compound at much higher rate. But the interesting part is not all these businesses remain static. Okay, so they keep rotating. There is small percentage of chances, but they keep rotating. So what if you bought this thinking like it will grow for 30 years and I'm going to make 46x return, but then the growth falters. Suddenly you find that jockey ka koi underwear बिक नहीं रहा या growth नहीं आ रहा है. You thought that it will keep growing for 30%. You thought that every year new and new men and women will start buying more and more jockey underwears, but it did not happen. So what will happen? Will market punish them? Of course, yes. So what will happen is their multiple will start going down. They'll say, oh, ये 40 p इसको दिया thinking 30 years growth story, ये तो शाहरुख खान होने वाला है, but निकला तो एक normal stunt hero, which is not going to survive in the industry. So there will be a fall in the PE. So because of which the stock price will get hammered. And that is where your exit systems are even more important, even in the core side of the things. But you don't need to monitor every day, right? Suddenly, overnight, Titan will not stop selling jewelry. It will take some time because it's very stable business. Long term, it is executed. They've built up strategy if it goes wrong. So even though there is a temporary hiccup, many times it comes back. So that is where you need a monthly charts-based entry-exit system. You cannot put it into a daily time frame and every day refresh the stock. Right? A lot of people post it. Sir, I just 3% down, Titan 4% down. What should I do? You sit, relax. Every day you don't need to monitor these businesses. You are working for a 10, 20, 30 years horizon, right? Every 2% fall, if you react, then how will you hold these kind of businesses? Okay.
On the other side, there could be 20% chance that this kachra can also, like in Lagan movie, you might have seen that kachra, right? Spin हो जाता है ball, उसको भी पता नहीं है कि spin हो रहा है, हो जाता है कभी कभी, right? So when that kachra starts taking wickets and that spin होना शुरू हो जाता है, that is called satellite opportunity, where this kachra might start performing, and because nobody thought कि kachra भी wicket ले लेगा, suddenly there is a big re-rating that happens. Yeah, suddenly that big re-rating that happens, and in a very short period of time, you start making multiple returns. Like railway stocks were regarded as kachra. Abhi spin kar raha hai, abhi wickets bhi le raha hai. So everybody now 10x in 2 years. Titan pada hai aise hi, right? Same way defense. Everybody thought HL is a kachra company, inefficient, not able to produce any aircrafts. They were thinking like kachra, abhi spin ho raha hai wapas, right? So that satellite can, kind of become like a core stock, but not every time they will sustain and remain like a core. Okay, so it will create a short delusion of being like a core compounder which can grow for 30 years, but it can again come back to kachra, and everybody knows कि हाँ इसका spin हो रहा है and technique सबको पता चल जाएगा, right? So it can come back to that same zone. So if you learned about stage analysis in our hackathon, why stage 4 happens is because that kachra is no more able to take wickets. It comes back to low ROC, or they are not able to execute. There are problems for growth. There is problem of longevity. All these kind of things will creep in. Only 20% of the times it can happen that kachra can become either mango or banyan. And if that becomes, you can even make 100x during that small time duration when market realizes that this is not actually a kachra. Now it has become like a, who is the hero of that movie, Lagan? What is the Bhuvan? So it has become like a Bhuvan, that Amir Khan. When they realize that kachra has transformed into Bhuvan, then they will start getting 50 multiple also. So are you getting it? What we do in core, why we do, what are the kind of business model, and even cyclical business model. When the steel cycle will be good, everybody will talk. It's a structural story. 10 years, steel demand is going to be there. Sugar demand is going to be there. Jab demand come hota, they will say this is very bad business and all that. But they will keep transitioning like this. That is called like a palm tree, which is not giving any shade. But when the season comes, at least you get some nariyal pani out of it. So eat nariyal pani again. Don't stay there, because if you stay there, you will get the heat wave. So there is no point. You just drink nariyal pani and move on. So you play the cycle and exit out of it. That is why it is called the palm tree, which is more like your cyclical companies, which has this trait to sometimes look like a cactus and weed, and sometimes it will look like a banyan and mango. But it's neither of them. It keeps rotating between them. The narratives keep changing between them. Okay. So are you now able to think with a crystal clear way how to think about business model? What are the kind of business models? Why low ROC? Why high ROC? What is reinvestment inside the business? A lot of bulb on moments you are seeing. Just type bulb on in the comment box.
Hope you enjoyed this video, and if there are any further updates, I'll keep you posted. That's it from my end. Thank you so much. If you are not yet connected with me, make sure you subscribe and like this channel. I am Vivek Mashrani, by the way. Those who are seeing me for the first time, I call myself as a TechnoFunda Investing specialist because I combine technical analysis and fundamental analysis for my long-term investing. And I'm author of bestseller books, which is You Can Compound in Action. If you're not read it, please pick it up from Amazon. And yes, keep compounding, keep growing in your journey. And thank you so much for being awesome.